Look, I want to start by being completely honest with you. I've been in this business for almost 50 years. I've sat across the table from Paul Volcker, worked alongside George Soros, and navigated through some of the most intense financial crises in modern history. The inflation of the 1970s, the stock market crash of 1987, the collapse of long-term capital management, and the 2008 financial meltdown. I've seen a lot, and yet what I'm seeing right now in 2026 regarding the US dollar is something I've never witnessed before. And I'm not talking about numbers that are suddenly shocking, they've been bad for years. What's different is that we've crossed a line where the trajectory is undeniable, measurable, and, frankly, alarming. I want to start with something most people fundamentally misunderstand. I've spoken to young people on college campuses about this, and almost universally, they get it wrong. The misconception is this: people believe the dollar's status as the world's reserve currency is an economic fact. It's not. It's a trust relationship. When Saudi Arabia prices its oil in dollars, it's not due to some natural law or a rigid financial rule. It's because the world has, for decades, trusted that the entity issuing those dollars will manage them responsibly. Similarly, when Japan holds U.S. Treasury bonds as a primary reserve asset, it's not because those bonds are intrinsically superior. It's because Japan trusts the United States to honor its commitments, to avoid inflating the bonds away, and to not weaponize financial sanctions in ways that make holding dollars a liability rather than an asset. Trust is the whole game. And right now, in 2026, that trust is eroding, slowly in some places, rapidly in others. Let me give you some numbers, because I'm a practitioner, not an academic. The U.S. national debt now exceeds $30.6 trillion, and the interest payments alone, without touching a single dollar of the principal, are approaching $1 trillion annually. Just think about that for a second. That's almost $1 trillion spent every year simply to service existing debt before we pay for one aircraft carrier, 1 mile of highway, or one Medicare prescription. And that number is rising. When you're running a 7% budget deficit at full employment, you're adding debt faster than the economy can grow its way out. A 7% deficit at full employment, this has never happened in American history, not once. I remember speaking at the Robin Hood conference a few years ago. I told the audience that if interest rates stayed where they were, by 2033, interest expense would reach 4.5% of GDP. And by 2043, just 20 years from now, it would hit 7% of GDP. To put that in perspective, that's 144% of all discretionary spending today, covering defense, education, infrastructure, research, housing, transportation, all of it, and then 44% more just on interest. And the reaction from Washington? A shrug. That is more frightening than the numbers themselves. The idea that those running the country can see these projections and simply shrug. One of the most important missteps in modern U.S. fiscal history, in my view, was what I've called the biggest blunder in the history of the Treasury. The media ran with this in ways that missed the point, but I stand by it completely. Janet Yellen made a critical error by not issuing long-dated bonds when interest rates were near zero. Think about it. During 2020 and 2021, every American with a mortgage refinanced. Every corporation extended its debt. Private equity firms locked in cheap, long-term financing. But the U.S. Treasury, it continued issuing 2-year notes at minuscule rates when 30-year bonds at higher rates could have locked in low-cost financing for decades. This decision, in my experience, has no precedent going back to Alexander Hamilton. The result is a short-term debt structure now rolling over in a world of higher interest rates, driving the interest payments even higher each year. There's no easy way out. Why does this matter for the dollar? Because trust underpins its value. Investors have tolerated this growing debt and deficits because of the dollar's reserve status, but that tolerance is finite. I predicted late 2025 or early 2026 would show the first signs of strain, and we are now seeing it. The dollar has fallen roughly 10% on a trade-weighted basis since the start of Trump's second term, with sudden drops, not gradual adjustments, after key geopolitical events and tariff announcements. That's the market speaking a warning that the world's confidence in the dollar is shifting. We can measure this in other ways too. The dollar's share of global foreign exchange reserves has fallen from 71% in 2000 to roughly 57% today. Some might argue that 57% is still a majority, but the trend is what matters. A decline from 71% to 57% over 25 years, with the pace accelerating, signals danger. Foreign ownership of U.S. Treasuries has also dropped from over 50% to about 30%, leaving Americans themselves, through banks and pension funds, to fill the gap. Central banks around the world are moving aggressively into gold, a clear signal that they are losing faith in paper money. China, Russia, Turkey, India, Brazil, all buying gold at historically high levels. This is not coincidental. Gold is a hedge against losing trust in the currency of the world's reserve issuer. Another crucial pillar of dollar dominance is the petrodollar system, oil priced and settled in dollars. It has created a structural demand for the dollar independent of U.S. fiscal policy. But this too is shifting. China is pricing more oil in yuan. Middle Eastern exporters are increasingly using non-dollar currencies. And early 2026 data shows the dollar's share of international payments dropped to 43.8%, down 3.7 points in just one quarter. Simultaneously, new cross-border payment systems are operational, creating a parallel financial infrastructure. While it won't topple the dollar overnight, every percentage point of structural demand lost erodes the privileges the U.S. has long enjoyed. Now, let's think about what all of this actually means if these trends continue. I'm not talking about a sudden collapse. Tomorrow the dollar will likely outlive me, but I am talking about a slow, grinding erosion of purchasing power and a gradual loss of the advantages that come with being the world's reserve currency. The first thing that happens is that foreign investors will demand higher yields to hold American debt. Right now, they tolerate low compensation because of the dollar's special status, but as that status diminishes, even incrementally, the risk premium rises. Treasury yields go up, mortgages go up, corporate borrowing costs go up, and the stock market, which uses the risk-free rate as a foundation for valuation, reprices across the board. Every asset tied to the risk-free rate feels the impact. The second consequence is a weaker dollar. Many people assume a weaker dollar is merely inconvenient for tourists, but it goes far deeper. America imports roughly $3 trillion worth of goods every year: oil, electronics, pharmaceuticals, clothing, food ingredients. When the dollar weakens, every single import costs more in dollar terms. And these costs don't stay with the importers. They're passed on to you, the consumer, at the checkout counter, at the gas station, at the pharmacy. This is exactly how currency weakness becomes inflation. And it's a 1970s style risk, not driven solely by the Federal Reserve's policy, but by the very trust underpinning the dollar itself. Then there's the geopolitical dimension, which is perhaps the most profound consequence. A huge portion of America's global power flows through the dollar. Sanctions work because the dollar is the world's reserve currency. Cut a country off from the SWIFT system, and suddenly it cannot trade internationally, a powerful economic weapon. But that leverage exists only as long as no viable alternative is available. The moment meaningful alternatives emerge, the moment nations can trade outside the dollar system, that leverage begins to vanish. And I'm not saying this has happened yet, but the infrastructure for such alternatives is being built and fast. Take the Iran situation in early 2026. On one hand, the dollar surged as a safe haven, confirming it still has that role. On the other hand, Middle Eastern transactions settled in non-dollar currencies jumped dramatically. Both dynamics exist simultaneously. The dollar is safe, but the storm is slowly being redirected around it. At the same time, it's important to stay balanced. I've been accused of being too pessimistic, but I'm not ignoring what the dollar still has going for it. It represents 57% of global reserves and is involved in roughly 89% of all foreign exchange trades. The euro remains the primary alternative, yet the eurozone is mired in its own political and fiscal difficulties. The yuan is not freely convertible. Bitcoin and other cryptocurrencies are far from being a viable replacement for the dollar in any meaningful time frame. In moments of real market panic or geopolitical crisis, capital still flows into dollars and treasuries. The dollar retains a safe haven premium, and that cannot be dismissed. Its position is still formidable. But history is instructive when it comes to reserve currencies. I've studied every major transition over the last 3 to 4 centuries, and here's the pattern. They never end in a day or even a year. They often take decades. And they always end in the same way, not because a competitor suddenly becomes superior, but because the issuer of the currency makes enough mistakes for long enough that the accumulated cost becomes unbearable. The British pound didn't lose reserve status overnight. Britain spent 2 world wars bankrupting itself, piling up debt and inflating the currency until the weight became unsustainable. And while this process unfolded, observers kept insisting, the pound is still the reserve currency. The decline wasn't linear. It started slow, then accelerated, until the tipping point was inevitable. Trust works the same way. It erodes gradually, then collapses quickly. The lesson I take from Paul Volcker is especially relevant here. Volcker was my favorite central banker, not because he was comfortable. He wasn't. He put the U.S. into a terrible recession. Unemployment hit double digits. Farmers drove tractors to the Fed in protest. But he did the right thing. He crushed inflation and restored credibility to the Federal Reserve. And because he was willing to inflict temporary pain, the country enjoyed 20 years of prosperity. That lesson is simple. Solving a crisis often requires someone willing to be deeply unpopular for a period of time. And when I look at Washington today, I do not see that person. Not in fiscal policy, not in monetary policy. The Fed declared victory on inflation too early. Fiscal policy is on autopilot, heading toward a wall. Solutions exist, but the political system has no appetite for the necessary pain. So what should you do with this knowledge? I am not giving personalized investment advice, and I am not your financial advisor, but conceptually, here's what I think. Cash is not a safe haven when its purchasing power is being systematically eroded. Holding cash guarantees a slow, steady loss. Gold, on the other hand, has been part of my own approach. I am not saying put everything into gold. I'm saying pay attention to why central banks worldwide are aggressively accumulating it. Ask yourself, do they know something you don't? Diversifying internationally is real protection against concentration in a single currency whose reserve status is under long-term pressure. Position sizing matters more than almost anything else. And George Soros, my mentor, taught me one principle that I carry with me to this day. It's not about whether you're right or wrong, but how much you make when you're right and how much you lose when you're wrong. Right now, concentrating fully in dollar assets without careful consideration of these dynamics presents an asymmetric risk profile. People who were unaware or ignored the warning signs will find themselves at a disadvantage when markets fully price in the erosion of trust. Those paying attention will have options, choices, and time to adjust. Those who are not, won't. And that is the crux of what I've been trying to communicate for over a decade. The point I want to make is that the world is quietly adjusting to a reality that many in the United States refuse to acknowledge. While we debate domestic policy, the rest of the globe is actively protecting itself against the risks of over-reliance on the dollar. Central banks aren't just holding treasuries, they're diversifying. They're buying gold, increasing allocations to other currencies, and establishing new systems to conduct trade outside the traditional dollar-based infrastructure. This is not speculation. It's measured, systematic action. And the longer we ignore it, the more expensive the eventual adjustment will be for Americans. Consider the petrodollar system. For decades, one of the strongest supports of the dollar's dominance has been that oil is priced and traded in US dollars. Every country needs oil, every country needs dollars, and that created a structural demand that existed independently of America's fiscal position. But this is starting to erode. China is pricing more oil in yuan. Middle Eastern exporters are settling more transactions in non-dollar currencies. According to SWF data from early 2026, the dollar's share of international payments fell to 43.8%, down from 47.5% just 3 months earlier. That's a 3.7 percentage point decline in a single quarter, the largest quarterly drop in recorded history. Let me be clear, that's significant. A shift like that, even if gradual over years, has profound implications for global demand for dollars and the associated privileges it brings the United States. Then there's the matter of alternative payment systems. For years, people dismissed initiatives like BICs, saying they were politically impossible or overly complex. China and India can barely agree on simple things, so surely they couldn't build a robust payment system, right? But they did. The BRICE cross-border payment initiative is now operational and processing real volume. As Middle Eastern trade increasingly bypasses the dollar, and as Russia develops its own messaging system due to sanctions, we are witnessing the slow construction of a parallel financial architecture. It doesn't need to replace the dollar outright to reduce demand for it. Every percentage point of structural demand that disappears chips away at the advantages of the reserve currency. And those advantages, the so-called exorbitant privilege, are the source of enormous economic power and flexibility for the United States. What happens if this continues? First, foreign investors demand higher yields. Treasury bonds have been attractive because they offered a risk-free, low-return investment for countries and institutions holding dollars. As confidence declines, yields rise. Mortgages rise. Corporate debt servicing costs rise. The stock market, built on the risk-free rate as a benchmark, adjusts downward. Second, the dollar weakens. This isn't merely a tourist issue. Imports become more expensive. Oil, pharmaceuticals, electronics, clothing, everything priced in foreign currency costs more in dollars, and that cost is passed on to the American public. This is inflation, pure and simple, driven not by Federal Reserve policy alone, but by the erosion of trust in the currency itself. The third consequence is geopolitical. America wields extraordinary influence because the dollar is the global reserve currency. Sanctions are effective precisely because other nations rely on the dollar to trade. But this influence is contingent. Build a credible alternative, and the leverage vanishes. The moment countries can trade outside the dollar, the effectiveness of sanctions diminishes. The early 2026 escalation in the Middle East showed this duality. The dollar surged as a safe haven, confirming its continued role, yet transactions in non-dollar currencies accelerated simultaneously. Both dynamics can exist together, illustrating a slow shift in global financial patterns that many fail to fully grasp. It's important to emphasize that the dollar's current position is still strong. It represents 57% of global reserves, dominates 89% of foreign exchange trades, and remains the preferred safe haven in times of crisis. The euro is hampered by political and fiscal uncertainty. The yuan lacks convertibility, and cryptocurrencies are nowhere near replacing traditional currency systems. Yet history shows that reserve currencies are not invincible. They don't fall overnight. Instead, mismanagement, cumulative errors, and a slow erosion of trust gradually weaken their position until a tipping point is reached. The British pound is a historical example. Years of war, debt accumulation, and inflation eventually undermined its dominance, and what seemed unshakable eroded faster than anyone expected. Trust, once lost, does not return quickly. Looking at the U.S. today, we lack the political will to implement the painful solutions needed. Volcker faced immense resistance, yet he acted decisively to restore credibility to the Fed. The result was decades of prosperity. Today, neither fiscal nor monetary authorities appear ready to take similar action. Inflation is considered under control, yet fiscal policy continues toward unsustainable deficits, and political appetite for the necessary discipline is nearly non-existent. Without leadership willing to make unpopular decisions, the slow erosion I've described accelerates, and the consequences compound over time. So, what does this mean for individuals and investors? Again, I'm not giving personal financial advice, but conceptually, cash is far from a safe haven. Inflation erodes its value steadily, guaranteeing a slow loss in purchasing power. Gold, international diversification, and strategic positioning offer protection against concentrated exposure to dollar assets. The broader lesson is risk awareness, understanding where the dollar stands, how reserve currency status works, and what global institutions are doing in response. The decisions you make today can determine whether you're prepared or unprepared for the consequences when markets eventually reflect these trends fully. Finally, transparency matters. I've spoken at universities about the federal debt not because students can fix the problem, but because they deserve clarity. Those who will live through the period when interest payments consume 144% of discretionary spending. The people living in 2043 are often the least informed about the trajectory today. Public data exists, but no one explains it clearly. Understanding these dynamics connects the dots. Mortgage rates, grocery bills, retirement savings, and geopolitical influence are all linked to the fundamental trust underpinning the dollar. Awareness is the first step toward preparedness. The reality is simple. Markets always price in risk eventually. They may take years, even decades, but the math does not lie. The trajectory of U.S. fiscal policy, combined with the deliberate steps other nations are taking to diversify away from the dollar, is creating a slow-burning pressure that cannot be ignored. The first wave is already visible in the form of higher yields on treasury bonds, rising borrowing costs, and more expensive imports. The second wave, geopolitical and structural, will unfold as parallel financial systems mature, as alternative currencies gain acceptance, and as central banks continue to accumulate gold and other assets. The combined effect will be a gradual erosion of the dollar's purchasing power and of the extraordinary advantages the United States has long enjoyed as the issuer of the world's reserve currency. What this teaches us is that reserve currency status is not a birthright. It's earned and maintained through fiscal responsibility, disciplined monetary policy, and the credibility of the institutions managing it. When those conditions are ignored, when deficits are run at full employment without a plan, when debt servicing costs are allowed to escalate unchecked, the trust that underpins the currency begins to crumble. And once that trust starts eroding, it can accelerate faster than anyone predicts, as history has repeatedly shown. The decline of the British pound, the fall of the French franc, the erosion of the Dutch guilder all followed this pattern: steady mismanagement, incremental losses of credibility, and eventual tipping points that happened more quickly than most had anticipated. Looking at the U.S. today, the situation is particularly stark. Interest payments are on an upward trajectory, fiscal deficits remain historically high, and political will to address the underlying problems is minimal. At the same time, foreign holders of U.S. debt are reducing their exposure, central banks are diversifying into gold and other assets, and alternative payment infrastructures are being built. These trends are not speculative, they are observable and measurable. And while the dollar will remain dominant in the near term due to inertia, liquidity, and a lack of viable alternatives in some respects, the long-term trajectory is unmistakable. The era of unquestioned U.S. dollar dominance is gradually coming to an end. It's important to emphasize that this is not a catastrophic prediction in the immediate term. I do not foresee the dollar collapsing overnight, nor do I believe the United States will lose its global influence suddenly. But the gradual erosion of trust, the incremental increase in risk premiums, and the slow decline in structural demand will have very real consequences for every American. Higher interest rates, increased inflation, more expensive imports, and diminished geopolitical leverage are all part of the chain reaction set in motion by this ongoing trend. What was once considered a stable, nearly untouchable foundation of global finance is becoming less so with each passing year. The lesson here is both practical and philosophical. The practical lesson is that cash, once thought of as a safe store of value, is no longer guaranteed to maintain purchasing power over time. Diversification, awareness, and strategic positioning are essential to protect against this slow erosion. Gold and other tangible assets, foreign investments, and careful consideration of currency exposure provide protection against the concentrated risk of holding primarily dollar-denominated assets. Position sizing, risk management, and a disciplined approach to wealth preservation become far more important in a world where trust in the dollar is gradually waning. The philosophical lesson is that leadership matters. History shows that restoring or maintaining trust requires decisiveness, credibility, and a willingness to make difficult, unpopular decisions. Paul Volcker's tenure at the Federal Reserve is a prime example. By enforcing discipline and prioritizing long-term credibility over short-term popularity, he set the stage for decades of economic stability. Today, we do not see that same level of resolve in Washington. The Fed declared victory on inflation too early, fiscal policy continues toward unsustainable levels, and political incentives discourage the hard choices necessary to restore confidence. Without leadership willing to accept short-term pain for long-term gain, the slow erosion of trust will continue unchecked. Ultimately, this is not about fear-mongering. It's about awareness and preparedness. Markets are patient but inexorable. The mathematical realities of debt, deficit, and structural shifts in global finance are not subject to political convenience or media spin. Those paying attention now, those connecting the dots, will have the ability to make informed decisions. Those ignoring the signals will be forced to react later, often at much higher costs. Knowledge is the first form of protection, and understanding the dynamics of currency, trust, reserve status, and global diversification is critical. In conclusion, the day the dollar loses, unquestioned trust is not a question of if, but when. It will likely be a slow process, measured in decades rather than days, but the direction is clear. Fiscal mismanagement, shrinking foreign demand, alternative payment systems, and central banks diversifying into gold all point toward a gradual reduction of the dollar's global dominance. For those who take the time to understand this reality, the choices are clear. Diversify, preserve purchasing power, and prepare for a world in which the dollar's privileges are gradually eroded. When the markets fully internalize this trajectory, the advantages of foresight will become strikingly evident. Think about it. The implications are profound, but they are not mysterious. They are visible, measurable, and actionable for anyone willing to pay attention. The question is not whether the dollar will survive in some form, but how the slow erosion of trust will reshape economic reality for those who live through it. And for me, after nearly 50 years in the markets, the lesson is unmistakable. The cost of inattention is far greater than the cost of preparation.